Silver's been on a wild ride. It's made new all-time highs in January, and then almost immediately we saw a sharp correction starting around January 30th. Was it overdue? Probably. Was it overdone? Maybe. Was there manipulation? A lot of people think so, myself included. And let's be honest, this wouldn't be the first time and probably not the last. London trader Andrew Maguire says it best. Realizing all markets are manipulated gives you a tremendous advantage. Now, I'm not here to tell you to buy or sell silver. I'm not here to predict where it's going next week or next month. I tend to zoom out. I focus on fundamentals. I look at the big picture. And while doing that, I came across some research by Clive Thompson that really caught my attention. He's a seasoned financial analyst from the UK, and if you haven't heard of him, I'd recommend checking out his channel. His claim is simple but serious. He argues that the COMEX Silver market is seeing much higher physical delivery demand than normal, and that March could be a reckoning month. Before we go further, let's quickly talk about what COMEX is and what it's supposed to do. CME is the parent company, and COMEX is the futures exchange. Basically, it exists so producers, refiners, and large users of silver can hedge price risk. Most contracts are never meant to result in actual physical delivery. They're rolled forward, they're closed out, or they're settled in cash. Only a small percentage, usually around 5 to 10%, ever stand for physical delivery. And that's important because Clive's point is that this behavior has changed a lot. According to Clive Thompson, what we're seeing now doesn't look like normal hedging anymore. We're seeing record physical deliveries, not just in big months, but even in the smaller ones. There are months now where nearly all open contracts are demanding physical silver instead of rolling forward. And if that continues into March, which is the biggest delivery month of the year, the math starts getting very uncomfortable for the COMEX. That's his claim. So let's slow it down, walk through the numbers step by step, and I'll give you my honest take on whether his math actually holds up. By the way, my name's Noel Lorenzana. I'm an accountant, not a financial analyst, but I find this kind of stuff fascinating. And none of this is financial or investment advice. Let's look at January, an anomaly month. Here's where Clive Thompson says the alarm bells started ringing. January is usually a quiet month for deliveries. But let's look at the numbers he highlights. January 2024, around 7 million ounces delivered. January 2025, about 12 million ounces. January 2026, nearly 50 million ounces delivered. That's not normal. Clive's take is that large players didn't want to wait until March. They were probably front-running delivery, meaning taking their metal early in case it wouldn't be available later. And he says this: when minor months start behaving like major ones, something underneath the surface has changed. Now let's look at February, which Clive refers to as the smoking gun. As of early February, nearly every open contract was standing for delivery. Not 10%, not 20%, almost 100%. In a normal futures market, that simply doesn't happen, because when almost every contract demands metal, the futures market stops acting like a hedging tool and starts acting like a physical drawdown mechanism. Now let's look at March, the COMEX squeeze month. Traditionally, it's the largest delivery month of the year. According to Clive, if even a moderate number of March contracts stand for delivery, not extreme, just moderate, the numbers stop lining up with registered silver available. And as of mid-February, that gap just got even worse. For the first time in years, registered silver has dropped below 100 million ounces. Check this out. That's currently about 93 million ounces as of February 13th. That's huge. The trend is steep and March is coming on fast. The March open interest could demand 120 plus million ounces, but only maybe 70 to 80 million ounces may be available according to Clive. He's not saying silver is about to explode. He's not predicting COMEX will fail. He's saying March could be a major stress test month, one the market hasn't faced before, especially at this scale. One reality check before we go any further. Even if things get tight in March, exchanges don't usually blow up like they do in the movies. What does happen are things like margin hikes, rule changes, new delivery incentives, things that push traders toward cash settlement. If you remember the story about the Hunt brothers, I'll link my video about them up here. People usually blame margin hikes for their downfall. But the knockout punch? It was something called Rule 7. COMEX went liquidation only, meaning no new long positions, no new buying, only liquidating positions. And once that happened, the trade was over. Silver dropped 80% over a few weeks. They were finished. So if March gets tight, the story might not be about default. The story might be about how the exchanges respond and whether that response builds or erodes confidence in the paper silver market. By the way, if you like this type of content, do me a favor, please be sure to like and subscribe. It really helps out the channel. Thank you. Does the math hold up? So now the big question is, does Clive Thompson's math actually hold up? Let's walk through it because this is where things get really interesting. First off, let's give credit where credit is due. Clive Thompson is doing what most people don't. He's converting contracts to ounces. He's comparing delivery demand to registered supply, and he's showing his original work. That puts his analysis miles ahead of the usual silver chatter and the AI copycats. He's also right that delivery behavior changed in 2025. More contracts stood for delivery. Minor months acted like major ones. And he says February is off the charts, but to be fair, I'm not entirely sure if his calculations are correct here, or maybe I'm just not understanding his calculations. Everything else makes sense though. So basically, if that trend continues, yeah, things get tight quickly. But now let's slow it down because here are some things that often get misunderstood. Number one, open interest does not equal delivery intent. Just because contracts are open doesn't mean everyone wants physical delivery. As first notice day approaches, things can change fast. Contracts can roll forward, positions close, spreads shift. Even in stressed markets, delivery percentages are elastic, not fixed. So it's kind of a wait and see, but things could get really interesting. 2. Registered silver isn't a fixed number. Registered silver is what's available now at the COMEX. It's not all the silver that exists. There's also eligible silver. That's silver in COMEX warehouses, but owned by someone else. It's not automatically available, but behavior can change if prices or incentives change. So the fact that eligible silver hasn't been reclassified yet tells us something, but not everything. In other words, the COMEX can probably get more silver somewhere if needed. 3. Exchanges don't just sit on their hands waiting for things to break down. They defend themselves, they raise margins, they adjust incentives, and they negotiate cash settlement. And they change the rules in their favor like they've always done before. Most failures aren't loud, they're quiet, managed, smoothed over, and in the case of silver, papered over. According to Clive Thompson, if someone with a short position can't deliver or buy back their silver position by March 30 at 1 p.m., the CME could invoke force majeure. That means the exchanges can force cash settlement at a price it chooses. And if that happens, anyone expecting silver would get dollars instead. What this reality means. Even if March comes and goes without any fireworks, the developments at the COMEX still matter because markets don't break in a single moment. Trust wears down slowly over time. First, it's a few delivery delays, then rising premiums. Then people stop believing the system can actually deliver what it promises. In other words, paper markets work until they don't. And there's one more piece of the story. Lease rates. That's the cost to borrow physical silver, and normally it's very low. But in 2025, lease rates spiked. And currently, I'm hearing they're over 6%. That suggests tight physical supply. Does it prove a squeeze? No, but it adds another piece to the puzzle. And just zooming out a bit more, this isn't only a COMEX story. We're seeing rising premiums and tightness globally. For example, look at this chart about the Shanghai silver supply. Silver inventories in Shanghai, China are collapsing. Available supply is down to 350 tons, which is about 11.2 million ounces, the lowest since 2015. That's an 88% drop from the 2021 peak of nearly 3,000 tons. And as you probably know, starting in January 2026, China banned silver exports except for a few select firms, basically their friends and family. The physical market hasn't been this tight in a very, very long time. We're talking decades. This could be a perfect storm brewing. Look, I'm not here to predict a default. I'm not here to be a fearmonger, but ignoring this data could be foolish in my opinion. At the very least, Clive Thompson's analysis gives us a clear signal that there's real stress underneath the surface and that you should be paying attention. Even if March ends quietly, this trend tells us something important. Physical silver is being treated differently than it was just a year ago. And if March comes and goes, keep an eye out for the rest of 2026 because May, July, September, and December are typically big delivery months as well. I'll link Clive's channel below. I definitely recommend checking out his full breakdown. And if you want to know whether we're entering the panic phase of the silver commodity supercycle, then you need to check out my video right up here. Thanks for watching, and I'll see you in the next one.